If you're a busy nurse working hard with the hopes of being able to retire early, your 401k or 403b, not going to cut it. Now, in this video, I'm going to dive into exactly why that is true and show you some alternatives that can help you retire early. My name is Amanda Ryba, and I have been working in the financial services industry for over 8 years, building my business, and I'm very passionate about working and helping empower nurses with financial education because I have a lot of friends and family members that are nurses, and I see how hard you work day after day, 12-hour shifts, just to be potentially on call that night. And it's just absolutely ridiculous that you can't be saving money to be able to get out of those hospitals as early as possible. And today I'm going to show you how to do it. So let's dive in. We need to start by defining, what does retiring early actually mean? Are you looking to retire by age 45, 50, 55, 60, 65? Well, unfortunately for half of these numbers, you just can't do that with a 401k or a 403b, and I'm going to show you why. If you check out what the IRS has to say about when you can access your 401k, this website will actually show you. So it says, generally distributions of elective deferrals cannot be made until one of the following occur. You die, obviously, become disabled or otherwise have a severance from employment, the plan terminates with no successor defined contribution plan is established or maintained by the employer, or, this is the big one, you reach age 59 and a half or experience a financial hardship. Those are the only reasons you can access your 401k early, and reaching age 59 and a half is the big one. That's what you want to be paying attention to. Now, there is an exception to this rule. There's something called the Rule of 55. Here's what Charles Schwab has to say about the Rule of 55. So hoping to access your 401k early, with the Rule of 55, you may be able to access and take early withdrawals from your 401k. Here is what you need to know. What is the Rule of 55? The IRS Rule of 55 recognizes you might leave or lose your job before you reach age 59 and a half. If that happens, you might need to begin taking distributions from your 401k. Unfortunately, there's usually a 10% penalty on top of the taxes you owe when you withdraw money early, right prior to age 59 and a half, like we just saw on the other page from the IRS. This is where the Rule of 55 comes in. If you turn 55 or older during the calendar year you lose or leave your job, you can begin taking distributions from your 401k without paying the early withdrawal penalty. However, you must still pay taxes, obviously, on your withdrawals. Not only does the Rule of 55 work with a 401k, but it can also apply to other qualified retirement plans such as a 403b. And if you have a retirement plan from your employer, you might be able to take advantage of this rule. You can verify whether or not you can use this exception by checking with the summary plan description you have received, or you can access electronically for your workplace retirement plan. Now, what are some things that we need to know about this if we actually plan to do this, right? Some very important things to know. Number one, public safety employees always get an extra 5 years, right? These are police officers, firefighters, EMTs. That's not you, so we don't need to be concerned with that. 2, you can withdraw only from the plan specific to the employer. So what does this mean? Before you start taking distributions from multiple retirement plans, right, prior to around age 55, it's important to note that the 401k withdrawal rules for those 55 and older apply only to your employer at the time you leave your job. So in other words, you can only take those penalty-free early 401k withdrawals from the plan you were contributing to at the time you separated from service. The money in any other retirement plans must remain in place until you reach age 59 and a half if you want to avoid penalty, which basically means that you can start taking money out of the employer plan from where you actually retired from at age 55 or older, but not any of the old ones that you have out there. You must leave your job the calendar year you turn 55 or later. The balance must stay in the employer's 401k while you are taking early withdrawals. You cannot go rolling this into an IRA. The Rule of 55 does not apply to individual retirement accounts. If you lose your job for any reason and you want to access to the 401k withdrawal rules for age 55, you need to leave your money in the employer's plan at least until you turn age 59 and a half. You can take withdrawals from the designated 401k, but once you roll that money into an IRA, you can no longer avoid the penalty. And if you've been contributing into an IRA as well as your 401k, you can't take the penalty for your distributions from your IRA without meeting certain requirements. And lastly, you can withdraw from your 401k even if you get another job. This is kind of cool, right? Basically, you can keep withdrawing from your 401k even if you get another job later. Let's say you turn 55 and retire from work. You decide you need to take penalty-free withdrawals from under the age 55 rule and begin to take distributions. Later at age 57, you decide you want to get a part-time job. You can still keep taking those distributions from your old plan as long as it was the 401k you were contributing to when you quit at age 55 and you haven't rolled it over into another IRA yet. So basically, what this is saying is this is an option on how to access your 401k or your 403b early. So basically what this rule is saying, this is your loophole. So if you do plan to retire by age 55, you can access the money that is inside of your 401k or your 403b if you retire the year you turn 55 or later, and only can you take money from the 401k or 403b at the job you actually retired from. So that is a nice loophole. But what if you're looking to retire at age 45 or age 50? Many of the nurses I sit down with are young. They're in their 20s, they're in their 30s, and they don't want to work into their 50s or 60s because they know how demanding the nursing field is on your body. And they just want to be able to enjoy time with their family, time with their honey, and be able to just live the lifestyle they've always dreamed of. Well, unfortunately, you cannot get to the money in your 401k or 403b or other qualified retirement plan prior to age 59 and a half, or like we just learned, age 55 with that special rule. So what is an alternative to that? An account that's really popular right now with all of my nurses in the medical field is called an IUL, or what we call an Indexed Universal Life. Now, what is this, right? It's basically, in its simplest form, a permanent life insurance policy. Yes, it's a life insurance, but we strategically are structuring it to be a supplemental stream of retirement income that you can access at any time, at any age, without paying any penalty, all tax-free. How do we do that, right? With an IUL, there is a base cost to an IUL. Let's say, for example, that you were getting $500,000 in life insurance. Let's say that cost you $100 a month. Well, if you contributed $500, $1,000, $2,000, anything in excess of the cost of the life insurance is going to grow and compound and be accessible to you in the future, all tax-free. Now, the key is you actually have to fund it, right? You actually have to set it up correctly. You have to fund it. And then because of the fact that it is a life insurance policy, it is not technically considered a retirement plan according to the IRS. It does not fall under the tax guidelines, the rule of 55 or the age 59 and a half rule. You can access money out of your retirement plan, out of your life insurance policy as a retirement plan at any age. Let me show you. This is straight out of one of the top insurance carriers in the industry, straight out of their illustration, explaining a little bit more about how the product works. Understanding the benefits of an Indexed Universal Life, protection, growth potential, and flexible premiums. Protection, Indexed Universal Life is a form of permanent life insurance, meaning it can be designed to last your entire life and provide a death benefit to your loved ones upon your passing. Growth potential. After policy fees and charges are paid, which is just the cost of the life insurance to you, additional money can be allocated to indexed interest strategies, which is a simple way of saying how your money grows. This gives the cash value the opportunity to grow. Then, flexible premiums. With IULs, you can make premium contributions when you want and in the amount you want, as long as you satisfy the contract minimum. A premium is just what you are saving into the account every single month, and there is a minimum that is required to just satisfy the cost to own the actual life insurance policy. But the goal is to overfund the cost to own the life insurance policy, because that's what's going to help your cash value grow inside so you have access to it at a later date. But let's scroll down and take a look at some of their additional benefits of an IUL. Guarantees, right? A guaranteed floor rate for the index interest strategy to create downside protection. That is a simple way of saying you can't lose money, right? They give you a 0% floor, so you can only earn on your cash value, you cannot lose. An initial death benefit guarantee that makes sure the contract stays in force for the early years, just meaning that you can't lose your life insurance. Cash for later. Supplemental income in retirement through tax-free loans and withdrawals, right? It says right here, access to your money all tax-free. You can use this to pay off mortgages and maintain your family's standard of living. And living benefits are available that allow you to accelerate your death benefit to help with unexpected costs. Meaning you get sick, injured, or ill and it's severe and you're down for 90 days or longer to recover, you can actually access the death benefit, the life insurance while you are alive to pay for any medical expenses you need. And those nurses out there that are listening to me today, knowing you work in hospitals, you can probably see the benefit to that. And it also comes with tax advantages, meaning tax-deferred cash accumulation. You're not paying any taxes on your interest. Tax-free loans and withdrawals. That's how you access your money, all tax-free. No federal tax penalty for early withdrawals before 59 and a half. You can get to the money inside of your IUL at any time, at any age, without any penalty. As long as there is money inside there, you can access it. And an income tax-free death benefit that pays out with no delay from probate. Meaning you pass away, your family will collect the death benefit, which is the life insurance, plus all the money that you've saved inside your policy, all tax-free, completely avoiding probate. Now let's see what one of our other top carriers also has to say. One of the other top carriers that I work with in the insurance space that does IULs pretty much does the exact same thing. Death benefit protection, living benefits, meaning you have access to the death benefit of the IUL while you are alive if you get severely sick or injured. Cash value, meaning you can access that at any time without penalty. And income. The cash value of the policy may be used as collateral for a policy loan. In addition to that, you can withdraw funds from the cash value whenever you want. This allows cash flow flexibility when you need it. You could put that money towards a college fund, mortgage payments, or any other future financial needs that you might have. There you go. Literally says exactly in the illustration from two different carriers, there's many others out there, exactly how this product works. Now let's take a look at an example. Here's an example of an IUL policy for a female that is 30 years old. I'm just basing her in California. Doesn't essentially make much of a difference there. And her goal is to aggressively save until retirement. She's 30 years old. She is a healthy non-smoker, which yes, you do need to get approved for these accounts because they are a life insurance policy. And the life insurance company wants to make sure you're not going to die tomorrow, right? So we do need to get approved. They look at your age, your health history, your criminal background, and that is going to give you a risk class. And this lady is a healthy non-smoker. And she's going to aggressively save $2,000 a month every month from age 30 to age 50 until she retires. Her goal is to retire early at age 50, which we just saw. We cannot do that with any other retirement account. Now, she might have to cut some expenses out to be able to do this, or she might just go work a per diem shift, pick up maybe a travel nursing gig somewhere to make some extra income where she can make this happen, but she's aggressively going to save. Now, in order to do this, she would need to get a $750,000 death benefit. That is what is accessible to her if she were to get severely sick or injured and need access to this death benefit for a living benefit need. The $750,000 is what she actually has access to while she is alive. If we shoot over here to the left-hand side, you will see how this works. Years, how many years the account has been opened. Age is how old she is in counting. Annual premium, right, assumed premium outlay is what she's saving every single year. So if she's saving $2,000 a month, that is $24,000 a year, and that is after tax dollars going in. This money has already been taxed. Now, these accounts can be set up where you start saving something smaller and you slowly increase that over time. They can be set up to be just big lump sums that go in. This example is just showing somebody saving $2,000 a month. I have done these for nurses that just put in $30,000 a year all at one time. I've done these for nurses starting at $250 a month, $500 a month. It's really whatever fits the budget. But if the goal is to retire early, you really want to get aggressive with what you're saving as quickly as possible. And if we shoot all the way over here to the right-hand side, you will see her earning interest. Accumulation value, that is her cash. That's the money that's essentially growing behind her life insurance policy. The surrender value is how much she has access to. So year one, she's going to have $21,700 in there. She actually can already access $9,595 of it. Now, if you all recall, with the 401k, the 403b, what's the earliest age we can access that? 55, right? If you actually retire at that, but typically it's 59 and a half. Here, she has access to it right away at age 30. We're not saying that she should touch it, but if she might need it for an emergency, she does have access to that. If we look 5 years in, she has $123,000 in here. She has access to $112,000 of it. As the years go on, she'll have access to a higher and higher percentage of her accumulated value. Eventually, the surrender value will disappear. So this shows right here, she will break even after that 15th year right here. Now, the death benefit category that you see over here is her life insurance, which is her $750,000, plus her accumulation value, 750,000 plus 21,000 equals 771,000. That's why this number is increasing over time. Now let's take a look at this, right? If she does this for 10 years, after 10 years, she would have contributed $240,000 into this account. And if we shoot all the way over to the right-hand side, you will see that she would have in here $292,000 and she would have access to $286,000 of it. Now, could you retire off that? Probably not, right? Not by age 40, but maybe she wanted to go buy some real estate, right? Maybe she's looking to get into some real estate investing or start a little side business or maybe just take a trip or travel with her honey. She can do all of that. But let's say she doesn't touch this. Let's see what happens. If we shoot back over here and we scroll down a little bit further, let's see what happens when she turns 50. If she really does save this $2,000 a month until she's 50, she would have contributed $480,000 into the account. And if we shoot all the way over to the right-hand side, she would have in here approximately $865,000 inside this account accessible to her at retirement. Now, we're only looking at a 6.3% rate of return. Most IULs on the market today average somewhere between 8 to 10%. It just depends on the strategies that you choose. So these numbers are probably much lower than what you'll actually see in real life, right? There's the possibility of that. But I want to challenge you guys to think, if this was you and you had $865,000 in here at age 65, what would you do with it? Would you take it all out at one time, or would you just take a little bit every year to live off of kind of like a pension? I mean, if she's really moving into retirement, the pension idea is probably what you would want to do, right? Use it as supplemental retirement income. So let's see what that might look like. If she chooses to pensionize it, right, which essentially just means she's taking out money to live off of every single year in retirement, if we look at this distribution column that has just appeared, this shows if she takes out her money in the form of a loan, right, we're looking at alternative loans here, she would be able to access approximately $74,500 every single year, tax-free, every single year, tax-free, till she's 60, till she's 70, till she is 80. Wow. Until she's 90. What is that? She would have contributed $480,000 into this account, and she would have taken out a total of $2.98, almost $3 million tax-free. I want you to ask yourself, if you gave me $480,000 and in return I gave you back $2.98 million tax-free, would you take that deal, right? Most people would say yes. $74,500 a year is just over $6,000 a month, and she's able to do that for literally 40 years. So I want you to think about this. If we scroll back up, she basically traded $24,000 a year for 20 years to be able to take out $74,000 every year for 40 years. Is that a fair trade? Yes, right? But this is the key. This is why it's so important to start retiring early, start the planning for retirement early, and start saving as much money as you can into accounts that actually allow you to access it early. She could access this much earlier than age 50. You saw money in there as early as the very first year. Now, that's also because this is properly designed and properly structured. The key here is we always want to make sure we're getting the least amount of life insurance possible for the amount of money the client is saving per year, because that does control everything. Now, more on that in the video that I link below that will talk to you a little bit more about how IUL policies work, but this is a fantastic account that could be amazing for any nurse that's looking to retire early. Hopefully you learned something today, and this gives you a little bit of direction as to what you are looking to do for retirement. I'm not here to say that 401ks and 403bs are bad accounts. They're not bad accounts. They're just not flexible enough to let you retire prior to age 55 if that's the ultimate goal, right? And also remember that you have to have that money consolidated. It can't be in IRAs. There's just a lot of rules and restrictions that may or may not make sense for you if that's what you're looking to do. IULs are fantastic accounts. They're not great for everybody, but they do work if you set them up early enough and you start max funding them as quickly as you can. Now, like I mentioned earlier in the video, these plans are completely customizable. There is no pull off the shelf type of product. They're customized to fit you, your goals, your budget, and as early as you want to access it as possible. The key is you just want to make sure that you are connecting with a licensed life and health agent that is well trained on how to properly structure these accounts to be supplemental retirement income. Not everybody knows how to do that, but my team and I are experts in it. We've been doing this for over 8 years, working with many, many nurses as well as people in any other field. and we love it. So if you'd like to work with us, all you have to do is just click the link in my bio or in the description below to get access to our calendar where we can schedule a complimentary client consultation with you to see if this is something that could be a good fit. Now, if you know any other nurses, please do me a favor and share this video with them. I made this specifically for them and for you to show you some different tools and tricks that we've been using for the past 8 years to get nurses retired early. And if you like this video and you want to see more videos just like it, just click that subscribe button and hit the bell to turn on notifications because I release a new video every single week. And again, it's been a pleasure having you on my channel. I look forward to seeing you back here next week. Have a wonderful day. See ya next week on YouTube.